Salesforce reported some earnings after hours, and they're down around 4%. So let's take a look at these earnings and see why they might be down 4%. Definitely a company, when you think of potential benefits for this type of environment that we're currently in, you definitely could see this kind of company could be doing pretty well. So we'll look at this and then look at their slides presentation, take a look at what they have going on, why investors might be not into this. But Salesforce posted a non-GAAP EPS of 70 cents, beat by 1 cent, and a GAAP EPS of 11 cents, beat by 10 cents. That's right. Actual profitability, baby. You gotta love it from Salesforce right there. Overall, obviously, you look at that EPS number and you're like, wowee, this stock's very highly valued. But hear me out, okay? There's reasons for it. Because this revenue line of $4.87 billion increased 30% year over year. Beat by $20 million. Not a massive beat, all things considered. I consider that just flat from my perspective. But very good 30% growth. Operating cash flow of $1.86 billion. That is pretty nice. Talking about take-home cash there. That is right. So the company guided for a slowdown in Q2 and cut revenue and EPS and cash flow estimates for the year. And that would be your reason why the stock's down. See, it's pretty easy to find out sometimes. And it's not unexpected. I mean, there's so many other companies cutting guidance. But when you look at a stock like this, it is a stock that actually is up year to date, which seems weird nowadays, but up 8.5% year to date. So maybe this is just a little bit of a cool-off period, right? Nothing too unexpected for it. Revenues grew 30% as expected, and core subscription/support revenues were up 31%, while professional services rose 20%. Gross profit rose to $3.61 billion from $2.8 billion. Net income fell to $99 million from $392 million, ahead of higher expenses. So, yikers. And it's not unexpected. Higher expenses are absolutely the case. Salesforce is going to be implementing some work from home offers. Obviously, we're talking about paying for people who aren't working. This has just it's a disaster quarter for any sort of personnel matters. I mean, costs go up for every company, I should say. Every company has costs going up, so it's not a big shocker. Cash from operations down 5% year over year. Liquidity was $9.8 billion at the end of the quarter. For quarter two, it's guiding a revenue of $4.89 to $4.9, which is light of the consensus of $5.03 billion. So definitely, I mean, that's a very narrow range of consensus there, or of estimates. A very narrow range. So they seem pretty specific on what they think they're going to do. Again, guidance can drag a good earnings report down. It's just how it goes. Non-GAAP EPS expected of 66 cents to 67 cents, below the expectations of 75 cents. And that's a pretty big difference there in terms of that EPS. So, for full year, it sees revenues of $20 billion versus the $20.75 billion expected, and an EPS of $2.93 to $2.95 versus the consensus of $3.07. So not overall good guidance, and that's why the stock's down. So we can expect the stock to be down with guidance like that, right? Not unexpected. Operating cash flow growth of 10 to 11% though on the year, so they are expecting a growth in cash flow overall for the year. Looking at these slides, we'll look at this Mr. Bear, this little doggy over here, and the elephant, and all of the good stuff. So obviously, company overview. They're a leader in philanthropy. Philanthropy, sorry. Whew, a little tired out here. They're a leader in culture and a leader in innovation. They're one of the world's most innovative companies. Forbes. They're the number one top company that cares. Top companies that care. Are you kidding me? People Magazine says so. Stupid. Just stupid. Salesforce is the number one CRM software provider worldwide by revenue for 7 consecutive years now. Pretty awesome in terms of that. They're consistently delivering durable revenue growth, obviously, as we saw that. More than doubling from $8.4 billion in 2017 to $17.1 billion for this year right now in fiscal year 2020. Pretty massive. Fastest growing top 5 enterprise software company with 17.1 billion in fiscal year 2020, which is down 29% year over year. They're uniquely positioned to help customers drive broad-based digital transformation. Good company overview. Look at the overview of the financial aspect of it. Obviously, durable top-line growth. Current remaining performance obligations of approximately 14.5 billion, which is up 23% year over year. So more money headed their way in the future. Obviously, when they complete these, what they need to complete to get that cash-ish. Remaining performance obligations in general of 29.3 billion, up 18% year over year. Guidance, we looked at that. Nothing too exciting as far as the guidance is concerned. We looked at these numbers as well. Operating margin of a negative 2.9% if we're looking at a GAAP basis, which I look at the GAAP basis. I always do. All right, you know me. Which is a overall decrease of 850 basis points year over year. Total quarterly revenue and operating margin. You see, it's a good looking chart, right? What can I say? That quarterly revenue chart for the past 2 years here looks beautiful. Operating margin, though, you do see a decline in operating margin. Not looking good. A decreasing or negative operating margin is not what you want to see. You kind of expect it to go the opposite way. You would expect the worst margin to be earlier on in the company's existence, not to decrease now, but it is. I don't know. I don't like that operating margin number there. Obviously, we're looking at a GAAP basis. That's what I look at. But as far as subscriptions and support, on the Sales Cloud aspect, they were up 16% year over year. Service Cloud up 23%. Salesforce Platform and Other up 62%. And Marketing Cloud and Commerce Cloud up 27% combined. Not too bad there. Just growth in every segment of their portfolio. Incremental investments in international, obviously. Americas, we saw 29% growth year over year. Europe, Middle East, and Africa. You see growth of 37% year over year. Okay. And Asia Pacific and China. And don't forget Australia. Okay, don't forget Australia. No, but you see a 26% growth there. Very nice, very nice. Remaining performance obligations, you see a continual growth there, which is nice. Because that's pretty much people are giving them work to do, right? That's what it shows. People are trusting them with these contracts, which just shows good signs of growth. Quarterly operating cash flow. You see, there's not much as far as trends are going here. Besides, Q2 and Q3 tend to be not as good for this company. So expect next quarter to have a pretty, I would expect, dismal free cash flow. Especially with the operating margins in which they are running right now. So cash balances, though, are strengthening, as you see from this chart, and we'll look at their balance sheet in a little bit, no doubt. So as far as their response, again, all companies are kind of doing the same. It's not too, I just don't care all that much as far as these responses go. They're all kind of the same deal. Increasing expenses from work from home costs, just everything going on. So Salesforce here, but you can see that they are the number one CRM application. 2019, taking up 18.4% of the market share, which is by far and away the largest portion of the market share. So they're serving customers with the most complete portfolio of products, all about these products and applications that they offer. And as they go into those segments, you see each segment as far as what they're giving here: integration, commerce, analytics, marketing, service, platform and other, and sales. All of them you tend to expect growth. 4-year annualized growth rates all listed on your right-hand side, all around the 10%, some more than 10%, closer to 20%. So that's overall good expected growth for the next 4 years at a minimum, and obviously you would expect that growth to continue beyond that. They're driven by values. Yeah, good for you. Good for you. So, let's see. So, unmatched scales focused headcount grew year over year, 31%. People are attracted to working for this company. So, they're hiring people to support the growth, really, So, extending the capabilities of the Salesforce Customer 360 with partners like Microsoft, IBM, Apple, Amazon Web Services, Google, Alibaba, Dell, Cisco, Hewlett-Packard Enterprises. Can you believe it? Appendix. Let's go. Shoot. Let's go right into this. I don't know if they're going to put the balance sheet on here. They're not going to. So you know what we're going to do? That's right. We're going to go right into the balance sheet with the clickety-clackety. You know, I love clickety-clacking on this keyboard like no one's business. So, company, let's see. Let's look at this earnings presentation. I'm sorry. A little bit of coffees. But that's okay. We can cough now and then, okay? Why would I look at the presentation? I was just looking at the presentation. He's lost his mind. We want to look at the earnings release and scroll all the way down as we do and get into this lovely balance sheet to talk about this company. Total current assets on this company. This is going to be a quarter-over-quarter comparison, a 3-month change. $14.7 billion versus $15.9 a quarter ago. Definitely see a decrease there, no doubt. Total assets in general, 53.6 versus 55.1 a quarter ago as well. So a decrease in that. So hopefully, in my opinion, I like to see a decrease in terms of liabilities. Are we going to get that? Let's look. Total current liabilities of $12.8 billion versus $14.8 billion. That's right. You do it. You see it. You see the overall decrease in liabilities. Oh, thank you for spending your cash wisely. Total liabilities in general of just 19 billion versus 21.2 billion last quarter. So a $2 billion decrease in liabilities and around a $2 billion decrease in cash or assets. So overall, they just took away some debt. I like to see that. So that leaves the total stockholder equity of $34.5 billion. Very good numbers for this company. That's a delicious looking balance sheet if you're interested or invested in Salesforce for sure. A lot going on for this company, no doubt. But we are talking about a P ratio of 1,000 and trading in a market cap of 162 based off an annualized revenue on this company of somewhere around 25 billion. So the valuation is steep. I can't lie to you. The valuation is very steep on this company. But I think the value comes with your investment if you believe this company is going to continue this massive growth. Talking about annualized growth rates of 20% for the next 4 years. And I could see it potentially happening, right? This company's run very well, and they're very future-proof, obviously. The business that they do is honestly future-proof. They're very well poised for the future, how the market will look, and I think they have a good potential. Valuation is too steep for me to buy in right now. Now, you would have been a very happy individual had you bought it at $124, but you didn't. Sorry, I didn't either. But a 52-week low of 115, son of a gun. Just imagine getting in at those levels. Just imagine getting in anytime. 2017, it would have been nice. But anyways, that's how the cookie crumbles. You don't always get in when you want to. And I'm okay with that. I have enough positions, but if this thing, I don't know. I mean, I can't give it a buy point at this point, a price that I think it's a good buy. Obviously, anything under 150 I think is a decent buy for this company, but even then the valuation's still steep. Even then it is. Valuation's it's just too rich for me. I'm sorry. I can't buy into the stock right now.